Beneath every nation's formal, visible public debt lies a massive, hidden architecture of potential state financial obligations. We call these contingent liabilities. They are financial obligations that do not currently exist, but only actualize into real debt if a specific future event occurs. Some of these are explicit, legally binding contractual arrangements, like formal deposit insurance. Others are entirely implicit, driven by the market's unwritten assumption that a state will eventually bail out a bank deemed too big to fail. Herein lies the central paradox of state finance. Deploying these guarantees is necessary to stabilize markets during a severe crisis, but doing so creates a massive, latent accounting black hole. Shielding stakeholders from economic loss inherently generates a behavioral distortion known as moral hazard. When investors know the state will absorb their downside, they take on extreme, reckless risks to maximize their upside. To understand how governments manage this, we will map the exact typology, calculate their mathematical price, and explore the regulatory regimes. To prevent sovereign debt crises, we must first mathematically define and regulate financial obligations that technically do not exist yet. The first step is classification, utilizing the macroeconomic statistics framework established by the TTFS. The TTFS, or Interagency Task Force on Finance Statistics, is an international body that sets standardized methodologies for tracking global debt. This structural map separates recognized liabilities from contingent ones. Contingent liabilities require a fulfilled condition before being recorded. The most common explicit contingency is the financial guarantee. Standardized guarantees, like student loans, pool large numbers of similar risks. Because the risk can be pooled in these standardized schemes, statisticians can calculate an expected average default rate. This predictable rate transforms the guarantee from a mere contingency into a recognized liability. This section of the chart shows a direct contrast, one-off guarantees. These are unique, bespoke interventions, such as isolated corporate bailouts or specific infrastructure loan guarantees. Because one-off guarantees lack a predictable pool of similar assets, the exact risk of calls cannot be reliably estimated. Therefore, they are kept strictly off-balance sheet until the moment they are activated. Statistical classification dictates whether a massive public risk sits visibly on a nation's balance sheet or hides in the footnotes until a crisis forces it into reality. This structural classification leads to a severe valuation problem. Incomplete markets make it incredibly difficult to assign an accurate numerical cost to a one-off government guarantee. As these guidelines explain, recording a guarantee at its total nominal value vastly overstates the risk, since not all debts default. One approach is the market value measure, comparing observable instruments in complete markets. The calculation is simple. You multiply the nominal loan value by the difference between the contractual interest rate of an unguaranteed loan and a guaranteed loan. Statisticians treat the guarantee as a put option on the underlying assets. The option is exercised if the asset value, V, falls below the nominal loan value, F. The lender then puts the loan to the guarantor, costing the state the difference. Rigorous derivatives mathematics transforms these opaque risks into a precise, quantifiable price for state intervention. Once a state explicitly prices and issues a guarantee, it alters the behavioral physics of the entire market. The IADI defines this reaction as moral hazard. The IADI is the International Association of Deposit Insurers, the global standard-setting body for deposit protection. When stakeholders believe they are protected from losses, they stop monitoring institutional risk. Bank directors are incentivized to use newly secured, lower-cost insured deposits to aggressively fund riskier, high-yield projects. Regulators historically tried to curb this using coinsurance, forcing retail depositors to bear a small fraction of the loss if the bank fails. Post-2008 data proves this strategy fails entirely. Retail depositors simply lack the data access and specialized analytical skills required to monitor complex, opaque bank portfolios. Instead of exerting calculated, rational market discipline, retail depositors faced with coinsurance panic and trigger destabilizing systemic bank runs. The very safety net designed to protect retail citizens inherently incentivizes the reckless corporate behavior that puts those same citizens at risk. If retail depositors cannot exert market discipline, who must bear the burden to keep institutional risk in check? Effective risk mitigation requires shifting the burden to stakeholders who actually possess the analytical capacity to continuously monitor the bank. This stack is a bank's capital structure. Capable stakeholders, shareholders, and unsecured debt holders sit lower down. To monitor risk, they must face total loss. A statutory creditor hierarchy enforces this. In a failure, it wipes out equity and subordinated debt first, protecting insured deposits. The constant credible threat of this total wipeout forces these specific debt holders to act as a private regulatory police force, actively pricing the bank's risk in real time. A public guarantee only safely functions if it is paired with an ironclad hierarchy, ensuring private capital bleeds before public money is spent. The primary tension of any modern financial safety net is containing chaotic systemic risk without accidentally subsidizing it. We deploy contingent liabilities to prevent systemic economic collapse, but doing so inherently invites moral hazard. To survive modern financial crises, these hidden obligations can no longer be ignored as off-balance sheet afterthoughts. They must be strictly mapped and classified as standardized or one-off by macroeconomic statisticians. They must be priced ruthlessly using options theory to reveal their true mathematical potential cost to the taxpayer. And they must be balanced by risk-adjusted premiums, insurance costs scaled precisely to the actual danger an institution poses, alongside a framework that guarantees unsecured creditor loss absorption. True financial stability requires accurate market pricing and correct stakeholder loss absorption, rather than the mere elimination of risk.